Greetings everyone, and welcome to Fireside Chats with Farrokh, episode number 2. I should say Fireside Chats and Coffee with Farrokh today, and it's my great honor to have my dear friend and colleague, Professor Suresh Govindaraj, whom you all know, present here with us for episode number 2. So Suresh, welcome to Fireside Chats, my friend.
Thank you, Farrokh. Welcome to a 10-minute session on an introduction to financial statement analysis. For those of you who have taken my classes before over the last 10 years, hopefully this brings back some pleasant memories. And some of you may be expecting me to talk about forensic accounting today. I'm sorry to have to disappoint you because forensic accounting in my mind is just a buzzword nowadays for something that is financial statement analysis. Of course, the only distinction maybe that sets apart forensic accounting is the fact that it may be a legal issue involved here. Usually, forensic accounting is an expert witness who's probably trained in financial analysis, who's testifying for and against some company or the government or whatever. Since forensic accounting demands a lot of financial statement analysis, I rather feel comfortable talking about financial statement analysis. I think it's a broader term. So what is financial statement analysis? Again, there is no fixed definition. I recall when I was going through college, financial statement analysis was whatever the professor thought it was. If you came from Wall Street, it's all about the exploits of people, what they did in Wall Street, especially the practitioners. And some guys who would teach it from the finance side would teach all about valuation. I really think that financial statement analysis should not be about valuation. Valuation is part of pure finance. Having said that, though, financial statement analysis is highly, highly interdisciplinary. What does that mean? Well, to be a good financial analyst, first thing, of course, it's true that you must know your accounting. But financial statement analysis is not only about accounting. But there's one thing I do want to say about accounting. I know when you come into a basic accounting class, you're probably groaning there saying, why should I learn all this stuff? It turns out that accounting, and I can tell you this because I have been dealing with this since I was a graduate student, the most important subject to me if you're doing investing is to understand accounting. There is no way out of it. It's a language of business. And without proper knowledge of accounting, you can never build anything about that. You'll never be a great financial analyst. You'll not be a great finance guy. Most of you may remember from your finance classes that you use accounting numbers first to even reconstruct what will happen in the future. That's one thing. So you need a solid base in accounting. And for prospective people who want to get into this field, I would suggest, even if it's painful, do your accounting properly. And then you need a lot of finance. No doubt about it. You need a lot of finance, a lot of micro theory, microeconomics, to some extent macroeconomics, because without knowing what the macroeconomic components of what's affecting the nation, you will not be able to put the whole thing in perspective. And then again, you also need to know other things. For example, you have to be pretty strong in quantitative techniques. And the reason being, a lot of things that come into financial statements, for example, derivatives, is highly mathematical, which is another reason why I started teaching option theory for EMBA classes, which I think without knowing what options are all about or derivatives, it will be very hard for you to go out and be a good financial analyst. Now, what is a financial analyst anyway? Well, a financial analyst is not a kind of person who goes around trading. It's not about speculation. It's not about trading. In my mind, and also research has shown that nobody has ever made money consistently trading. You might hear all kinds of stories about, this guy who made a fortune and that guy who made a fortune, but then you don't hear about the same guy when the guy fails. Most people get cleaned out, and people who do make money oftentimes mistake the money for brains rather than luck. And this is also true of many big names like Goldman Sachs, or, Morgan Stanley, you name all these big companies. Of course, they have an advantage in trading because they have very fast computers. But it's only a question of how fast you're going. So that's not going to be something that which I would recommend. Now, financial statement analysis is much more, for a lack of a better word, much more sober people over the long period of time. You want to put your pension money somewhere. You want to invest for the long run. You want to be a little risk averse, which all of us are in some extent. It's not for gamblers. And then you look at this series of numbers that a company generates. And I can tell you this for a fact. If you're really good at it, we look at the last 5 years, quarterly reports, you should be able to reconstruct everything about the company, almost everything. Of course, there'll be hidden secrets and there'll be things that are hidden. But if you're really good at it, you should be able to spot what is hidden too. And that's the art form of it. Whatever I teach in the class, of course you can learn. There is no substitute for practice. You've got to keep practicing these things. And then the remaining 25% is pure art. Not everybody can be a Warren Buffett or somebody like that, who can see numbers and see what comes out of them. So, but still, 75% is good enough. In the financial statement analysis class that I teach, I also include a section on mergers and acquisitions, simply because mergers and acquisitions shows up in the financial statements. It's fairly complex accounting treatment. And the reason I do this is because most of the companies that you see are normally conglomerates. So without a knowledge of mergers and acquisitions and how it's done, and also the tax aspect of it, which is why I teach a section on taxes, you'll not be a complete financial analyst. Now, since this is a very short introduction, let me pose the following question to you. Suppose I put you on the board of directors, especially now, given the financial climate now. You're the finance director sitting on the board, and then some manager comes by and gives you reams of data. How quickly can you conclude whether the numbers are correct or not? For lack of a better word, let me use the word the numbers are kosher or not. It's a typical New York word. I suggest the following technique. Go back to the basics. Always the basics and common sense. First of all, you must be fully aware of what the company is doing, its history, what they're doing, in which sector they are in. So I'm assuming that you'll do all the homework anyway. Now, let me bring you back to basics. What does it mean to bring you back to basics? Well, let me put down this equation. I'll describe to you what it is. For those of you who have seen it in my class, God knows how many times. The left side is assets. Okay, these are the things that are supposed to generate future cash flow for the company. The right side is how you came up with the money to buy those assets. And this is also known as the accounting equation, the balance sheet equation. Now, the key thing in this is to realize, and this is the most important thing, and this is part of forensic accounting, you must be able to account for every source of financing for the assets that you have in the company. If you cannot account for a particular asset, I think what's the best analogy? I think it's you should apply the Roach principle. Some of you might be familiar with my Roach principle. The Roach principle is what? If you see one roach on the kitchen counter, there are probably hundreds behind. So the thing is always to start with something like this. First of all, let me just say one thing. Financial statement analysis, as opposed to the legal side, has a different principle. In law or in courts, everybody is innocent till proved guilty. In finance, I suggest you take the tack that everybody is guilty till proved innocent. And that's what I would do. If you expect the worst, then even if something a little bit better happens, you'll be extremely happy. So in a way, I'm asking you to be a pessimist. If you're a complete pessimist, you'll never be disappointed. On the other hand, you'll also learn how to, everybody's a crook, so you'll go deeper and deeper into the numbers. If this process leads you to the conclusion that everything looks good, looks kosher, the company must be good. All right, that's the kind of analysis I would take. So in some sense, you don't have to be a pessimist in real life, but when it comes to being a financial analyst, I suggest you take the tack that everybody's guilty. And then let them prove that they're not guilty through the numbers. Okay? Another little trick in this is to not talk to people who are involved in the numbers. Because you start talking to them, instead of looking at the numbers, they'll probably influence you. They'll tell you stories about their personal life, you feel sorry for them, and then you lose your objectivity. So best thing is to forget about people, lock yourself in a room with 5 years of data, quarterly data, and then try to see how much you can get out of this, and you ask the questions. And I suggest that you should put the emotions away. Because you cannot be objective if your emotions kick in. Now, how does this equation work? By the way, let me say another connection with finance. if I just change the symbols to read this way, suddenly we are in the realm of finance, corporate finance. This is accounting. It's basically book value, the way accountants keep their books. This is corporate finance because this is based on market value. V is the market value of the assets. D, the market value of debt or liabilities. And owner's equity, it's a share value that is seen in the markets. Obviously, the second equation depends whether the company is traded or not. So, if a company is not traded, the only numbers you have are the accounting numbers. And this is a classic problem of IPO. Given accounting numbers, how do you go to the market value? Some of you might realize this is a question confronting most IPOs. All you have is accounting numbers. How do I come up with a value? As you can see, for example, Google or whatever, most of them don't know how to value it. And the numbers they set are often different from what the market thinks it should be. All right? Since I'm not teaching in valuation, I just wanted to point out the connections. The questions you ask are the same in finance as well as in accounting. Also, let me begin with the analysis. Suppose you're sitting again, go back to your board of directors. The first thing I want to say is forget about the financing part. Focus first on the asset side. The assets are the ones that really give the company the reason to live. What does it mean? They're the ones which produce something for the company. So if the assets are not performing well, nothing you can do on the right side will ever help you. So the first question you should ask is, how well are the assets performing? The answer to that question is pretty good, whatever pretty good means, obviously relative term, but you can make a judgment call. You can look at the other companies in the same field and see if you're above the average or not. One more thing here about financial analysis. There are two things you should do, which is nothing different from what you do in personal life. When you're analyzing a company, you should look not only at where they are now, you should also look at a series of past data. When you start looking at the past data of the company, in the language of statistics, it's called time series analysis. On the other hand, if you freeze time and look at the data today, you compare it with your peers, it's called cross-sectional analysis. Now, which one should you come out ahead on? Obviously, you'd like to come out ahead, number one on both counts. You have improved a lot over the years, and you're number one now, you've beaten the pants off all your competition. But if you're forced to choose between the two, you should always come out front, I would say, on the cross-sectional front. Who the hell cares how you came along the last 5 years? If you have improved a lot over the last 5 years, but everybody else has done even better. For example, if you started running a mile about 10 years ago, when everybody was running it at 20 minutes, you did it in 10 minutes, or say 15 minutes. And after 10 years, you're still running at, say, 12 minutes, and everybody's running at 5 minutes, you pretty much will be out of the market. So essentially look at doing well over time as a consolation price. So if you're asking me where you should come out front, I should say on the cross-sectional analysis. You've got to beat the pants off all your competition right now. And also, of course, you want to come out ahead over time. You want to constantly improve. Now, going back to the questions, there are only two questions you need to ask. One is, how well are the assets performing? How well are the assets performing? What does it mean? It is pretty easy to see what it means, at least from an intellectual perspective. Well, you're looking at the left side of the equation, and the numbers you have to look for basically are twofold. One, you should look at the income statement, which tells you how well the company is performing in terms of its profits. And the other one is a cash flow statement, cash flow from operations. So the two things that will tell you how well the company is performing in terms of its assets would be the cash flow from operations and the income statement. Strangely, Wall Street seems to wait for income statements, the earnings reports coming out, which in my mind is okay. But I think the cash flow from operations is equally important, sometimes even more important when the company is in trouble. In fact, I would argue when a company is in trouble, the income statement really doesn't matter because it's kept on an accrual basis. It's really whether you have enough money to pay your bills tomorrow, which means you need to look at the cash flow from operations. So if the cash flow from operations is not working very well and you're already in trouble, chances are you won't exist in the future. You cannot pay your bills. So you should be able to analyze both of them together, and one depends on the other, as you know. Let me say one sentence about cash flow from operations. It's really difficult to analyze. You really have to put in the effort to understand how the cash flow from operations are computed. So I would urge people to look at the cash flow from operations and also to understand how it's made. So let's say you look at these two statements and then compare it with other firms and an average, and they come out better on both fronts. Say you're doing better than the average, much better than the average over time and across space or cross-sectionally. So the answer is yes. Then you go to the next step and ask the question, how well is the firm financed? Or what firm financed? Now, what does this mean? You will not even approach the second question unless the answer to the first question is the company is doing well. Because you know very well if the assets are not performing, there's no point worrying about how you came up with the money because the company is not going to live too long. The right side of the equation is what is taught in corporate finance. How much debt and how much equity. This seems to be a big thing in corporate finance. But to me, it's secondary to the performance of the assets, which is what we study first in financial data analysis. All right. So what does it mean to finance the firm properly? Well, as you can see, there are two sides. So you got to pick a side first. Let's pick the side of the shareholders. In the left side, only one thing, assets, how well the assets performing. I'm going to look at this picture from the side of the shareholders, which is normal because we want to maximize shareholder value. All right. So pick the side of the shareholder, and then you'll get some really good observations on how well the company is performing from the perspective of the shareholder, which means you don't really worry about the company that the company is doing well from the side of the bondholders. And this leads to a lot of games. Essentially what it is the shareholders want to milk as much as they can from the company. And as you can see from the equation, they don't, and what does it mean to milk the company? Well, basically you want to put the minimum possible risk and extract the maximum. And this leads to so-called games between debt holders and bondholders and equity holders. And what does it come out to? Well, if you answer this question from the perspective of the shareholder, it could lead to weird situations. But remember the thing, you don't want to torture bondholders completely. Because as a wise shareholder, even though you want to risk somebody else's money, namely the bondholders, to buy those assets, the bondholders are not silly. You have to also make sure that you don't kill off your bondholders. You got to keep them reasonably happy to keep lending you money. But a strange thing about finance, which goes against all the conventional wisdom that we have seen, probably handed out from our grandparents and our parents, don't borrow too much money. You'll see the whole tax structure as well as the system of equations forces you to be wise. And what does it mean to be wise as a finance person? Push as much financing to the debt holders and borrow as much as you can. And that will help you more because from the side of the owner's equity, the bondholders are just paid interest. Whatever goes beyond that belongs to the shareholders. And another key thing about the corporate side is something, if you're a corporation, you have limited liability, which means what? Which means if the company goes bankrupt, you cannot pay, just give the shell of the company back to the bondholders with nothing. So essentially the downside risk is protected and it's all upside potential. So in this game, who's a little vulnerable is the bondholders, which is why they protect themselves with all kinds of bond covenants, rules, all right? But as a shareholder, it will turn out that look at the two ratios that I recommend that you look at, and this will be the final part of what I'm going to say. For this, I'm just going to mention it. We'll go through it in detail in my next lectures. Is ROA, return on assets. That's the important ratio, and you can look it up. It's available freely. And this one, ROCE, is return on common equity. So these are the two ratios that I look for. And a couple of other ratios that you want to look at if you're investing are two ratios which I recommend. Price earnings ratio, which basically is the market price divided by the earnings of the company on a per share basis. Look at it carefully, compare it to historical things. And if it is too highly priced, then stay away from these things, which is what you saw in the dot-com company. Earnings were negative and the prices were zooming. Kind of silly. And other one that I recommend is market to book. Market to book is the market value of the company compared to the book value of the company. If that number is very large, again, the company is overpriced. If these two numbers are very large, from an investment perspective, I would stay away from the company. When I say very large, obviously much more than the S&P index. All right? So these are the things. The answer should be the company is very good in ROA, well financed from this without hurting the bondholders, and these two numbers from the finance side or the investment side should be not too large. If they're too large, they're probably the company is overpriced. Looking for value companies means what? Companies that are undervalued in the market. Despite the fact, and a lot of things that I teach, I actually practice. Actually, most of my money is in the market for the long term. Now, if you recall, not long ago, people are saying you should invest in small firms, small cap firms, so on and so forth. But it paid off for a short time. But in the long run, it's not clear that's a good strategy. Small firms are usually, what will happen? If there's too much demand for small firms, the prices go up, market value goes up, it becomes overvalued, and they're too risky. So all it comes down to is the standard thing. When you get more rewards, don't ever forget, there is no free lunch in the market. What does that mean? No free lunch. Well, there is no arbitrage. Okay, so basically, if you're getting a lot of returns, it automatically means you're taking a lot of risk. All right, so if you want to be a little conservative, I would say stay within the bounds of PE ratios, market to book on the investment side, and make sure a company is doing very well on these two fronts. Okay, and for this, obviously the whole class is all about how to look at these numbers, the tax side and everything, and it's a vast field. But I would say the payoffs are very high, and for those of you who are contemplating learning the subject, I think it's a very pretty subject. So I would seriously, it is very pretty, so I have nothing else to say, otherwise I won't be teaching it. All right, so thank you very much. I hope you got a little feel for the subject that I teach, and hopefully you'll come back to classes to learn more. And by the way, I will be giving a lecture to the alumni thing get-together that we're going to have in March. And I deliberately picked a topic that you might find interesting. It's called market anomalies. Market anomalies simply mean that we don't have the right models. All the standard models that you learn in your class, I'm sorry to say, don't work. So people are making money in anomalies, and I'm going to talk about a few of those where people seem to have made money, myself included, for a short term, till people learn about these tricks. So this is the topic of my lecture. Hopefully, I'll see many of you coming back for this anomalies lecture. Hopefully, some of you will incorporate that in your investment strategies. And it will be good to see all of you again. So that's all I have to say. It's been a pleasure talking to you. Thank you so much. And see you soon.
Suresh, that was perfect. It was right on target. And as always, everyone, Suresh Govindaraj does not disappoint. And you also got several Sureshisms. So you got it all in this one. Thank you again. And before I swing back, I actually have a final question for you. You folks have all my coordinates. You have my email address, langdana@business.rutgers.edu. And you have my phone number, 973-353-5620. So reach out to me anytime. And we look forward to seeing you at the Back to School reunion on April 5th. So save the date, everyone. It's going to be Suresh. It's going to be myself, and I'll be doing something in macroeconomics on hot capital flows and the world after Ben Bernanke. And I cannot wait for that day. And Suresh, you're going to be speaking on market anomalies at the Back to School reunion. That's right. Could you just give us a teaser as to what market anomalies are, please?
Well, Farrokh, market anomalies are the so-called deviations from standard finance models, which is showing that the markets are not efficient. And a lot of hedge funds and a lot of these investment banks are exploiting these things. I'm going to talk about 5 or 6 of those anomalies. And hopefully you can try them at home yourself. And maybe you'll make tons of money too. Okay, and I hope to see all of you on April 5th. And you're welcome to write to me after that and keep in touch with me, but no stock tips.